What we're going to do now is take you through 2 or 3 stocks to show you how we think and to give you a sense of some of the opportunities that we're looking to play in the portfolio. The first one is a minute one investment that we made in the fund. So the very first day we started running the fund, this was the first stock that we bought. The stock is Macquarie Telecom. Its stock ticker is MAQ. And the theme that we're playing here is cloud technologies. Macquarie Telecom is actually a data center owner and operator. The trend that we're playing there, as I suggested, was that enterprise computing is migrating to the cloud. That cloud has to live somewhere. That somewhere is a data center. Data center business models, we find them very attractive. They offer high returns over a long period of time on hard assets. COVID-19 arrived and accelerated the demand for data center capacity. Macquarie Telecom have responded, and they're expanding a competitive site they have here in Sydney at Macquarie Park. This expansion, on our calculations, more than doubles the profit pool available to Macquarie Telecom's entire business. And critically, because of the great cash generation in Macquarie Telecom's existing business and its existing high-quality balance sheet position, this entire capacity expansion can be self-funded, meaning there's no equity required to be issued to get this expansion done. So the full expanded profit pool drops straight through to the earnings bundle for existing investors. Management team here have a very long track record of value creation. So our thesis in summary is this is a defensive growth asset with a pipeline of growth opportunities, and its expansion is fully funded. We think this stock is worth $70 today. It's trading around 45 to 50 bucks, and we think these types of assets in the long run are very likely to be owned by pension funds or something like the Future Fund. And we can see those types of funds are increasingly active in buying digital infrastructure because of the certainty over cash flows that you can see now in the world in which we live. And if one of those players wanted to come along and own this asset, well, they're going to pay a lot more than $70, we think. I'll hand you over to Dom. He's going to take you through an interesting travel stock.
Thanks, Gary. So corporate travel management, stock code is CTD. Look, this is a recovery trade at the moment. It sits in that tactical bucket. However, this used to be a rockstar tier 1 grower, and we think the opportunity is that the market realizes that the business does significantly better and gets re-rated over time. So look, corporate travel management, they play in a very large market. US 1.5 trillion is the opportunity set they're going after. They are very small with only 1% market share, so there's a very long runway for growth. This was a very strongly growing business pre-COVID. They were growing organically 15 to 20%, and they were also consolidating the private market. The reason we like this business is not just for its leverage to a recovery in corporate travel activity. It is because we believe this company has a very strong competitive advantage, and that competitive advantage is underpinned really by its technology stack. The business has internally developed its own booking tool, and what that allows is very significant margins. It makes the business very scalable, and it gives it superior margins and much better cost structure than its competitors, which allows it to take market share. Now, the big incumbents it goes up against are the likes of Amex and some very large players which don't have the technology that this business has. They're very people intensive, and when COVID came along and disrupted the market, the response from those companies was to cut costs, which meant cutting people, which means weakening their competitive advantage. Now, corporate travel management didn't have to make such drastic cost cuts. It is looking to take about 20% of its cost base out structurally, so it will be a much more profitable business on the recovery. The other reason that we like this business is that they didn't have to raise money at the bottom under emergency scenario. Rather, they generated some cash, paid down debt, and then seized upon the opportunity that was presenting to them. And they went away and acquired a business called TNT, Transport and Travel, which was the largest mid-market player in that US market, which is a very large market and quite hard to crack. one of the key advantages of that acquisition and why we think it is transformative is that that business does not have its own technology. It licenses its booking tool. Now, corporate travel will go away, get access to the customer base, and then drop in its technology stack and lift the margins of that business from 10 to 12 up to, potentially 40, 45%, which it enjoys in other markets where it has scale and high levels of automation. On valuation, we still think valuation stacks up, notwithstanding the run the stock has had. You are paying about 11 times recovered earnings on this business, and it used to trade on about 15 to 17. We also think consensus estimates look very, very conservative. We actually think the recovery will be stronger than what is factored in by the market.
Thanks, Dom. We're going to close out with another stock, but this is a play on the electric vehicle rollout that we're seeing happen globally. So the company we've got here is called Orocobre. The stock ticker is ORE. Orocobre are a lithium producer, and lithium is one of those feedstock components that go into creating batteries that go into those electric vehicles. The electric vehicle theme is being driven today by significant amounts of stimulus into the European market. The Europeans have got behind the green theme, and particularly behind their automakers making the transition from internal combustion engines to battery-related vehicles. So this is a multi-decade demand growth type play that we're investing in here. It's effectively the decarbonisation of transport. Orocobre's assets are high quality, very competitive, low cost curve positioned, and that's why we like it. We think assets in lithium that are low on the cost curve have earned the right to be those assets that get expanded. We see Orocobre's costs for a ton of lithium carbonate production, which is the unit that gets sold into the electric vehicle value supply chain, is somewhere between $3,500 and $4,000 US a ton. The marginal swing producer of capacity in that area is going to be faced with a cost structure of $10,000 to $12,000 US per ton. And that's significant because that offers a significant margin opportunity when times are good and a buffer when they're not so good. The second thing that we like about Orocobre is it has a huge mine life. The asset that they have is a salar in Argentina called Olaroz. It has a 1.2 million ton reserve. That means that they think there's 1.2 million tons of lithium carbonate equivalent that may be extracted from that asset, and they've only drilled out about a sixth of the underlying resource. So today it's got a nameplate capacity which would give it a mine life of 29 years. It's clearly not going to have a 29-year mine life given the backdrop of what's going on in electric vehicles. We see significant expansion capacity on the horizon for Orocobre, and indeed they've got themselves a phase 2 expansion event that's happening, and that will come to market inside the next year. If that isn't enough for you, they've also got an undeveloped salar that is 3 times the size of their existing asset, and that's in there pretty much for free in our view. So you've got huge long-term scope for expansion. Our valuation on this one is around $8 to $10, depending upon your lithium price assumptions and how quick they bring these expansion phases on. And today it trades at around $5 in the market. So that's some examples of 3 stocks to give you a sense of the investment lenses that we apply to the opportunities that are ahead of us.